Investing in stock markets for beginners. Investing in stock markets is a risk. While you could earn small or earn big, you could lose small or lose big and end up empty-handed. The 5 need-to-knows for beginners. Number 1. With investing, you're taking a risk with your money. Investing is a long way from putting your cash in a savings account where it sits to earn interest. Instead of the security of guaranteed returns, you're taking a risk with your money. The hope is that you make a lot more than you put in, a juicy profit. But there's the possibility you end up with less, a nasty loss. This video is first and foremost about investing in stock markets. It's most people's first experience of investing. And putting your cash into these markets is exactly what it says on the tin. You buy shares in one or more companies with the aim of making a profit. And although there are different ways to do it, such as funds, the principle of investing remains the same. You're taking a gamble with your money as there's no guarantee you'll get it all back. In the worst-case scenario, you could lose it all. While the concept of stock markets may trigger images of young brokers yelling buy, sell, heads in hands one minute and fist-pumping the next, the reality of long-term investing tends to be rather more mundane. Pick a few shares or funds, keep an eye on them, and then cash them in when you need to. Number 2. A stock market is like a supermarket where you can buy or sell shares. To keep it as simple as possible, and for the purposes of this guide, a stock market is simply a place where buyers and sellers meet to sell shares. Each one a tiny part of a company listed on an exchange. See below. Why do shares exist in the first place? To grow and hopefully boost profits to turn a business into a financial success. Firms offer investors the chance to back them with their own cash. Enter a stock market. In return for your cash, a business offers you a share in its future. So you essentially own a tiny slice of that company and become a shareholder. And if you wish, this slice of the company you own can then be traded with anyone who wants to buy it. Number 3. You can make money, but you can also lose it all. There are no guarantees. What kind of growth can I expect from investing? This is usually the question that most investors want an answer to. Potential growth drives most people's decision to put their cash into the stock market. We'll be blunt. We can't actually tell you what you will get. And don't believe anyone who says they know. They're lying. But we can give you an idea of what can be achieved. Although rates on savings accounts have seen some recent upward momentum, inflation is still soaring well above them. Understandably, the incentive to look elsewhere for decent returns remains strong. Of course, everyone would prefer to make 5% on their cash, but only if you take the right level of risk to suit you. Warning: investing is risky, and any money you put in could fall in value. Put bluntly, you could lose it all. There's a reason you'll see the phrase past performance is no indicator of future success. You've no guarantee your investment is going to do well. Number 4. Only you can decide if investing is right for you. It doesn't matter if you're about to buy your first share or pick a stock market fund for the first time. Always ask yourself why you're looking to invest. Over the long run, historically stocks and shares have outperformed money in savings accounts. But that's no guarantee they'll do so in future. It's all about your personal circumstances. For example, you might be one of the many who have despaired at the rotten rates on offer in savings accounts and are prepared to take a risk in the hunt for bigger returns. Or you may have drawn up a well-researched plan to save £10,000 over the next decade to help pay for your children's school fees. In both these cases, it's a clear green light to go and invest. Tip: be careful if somebody offers you advice and take a good, honest look at your finances. Number 5. You should never invest more than you can afford to lose. Too many people think you need to have a load of cash to be able to invest in the stock market. You don't. And many smaller investors who drip feed in small sums on a regular basis can do much better than those who simply dump a big lump sum into the market. As a rule of thumb, you should never invest more than you can afford to lose. This is because, in the event of a stock market crash, you could face losing a huge chunk of your wealth if you have too much of your money invested. Many financial advisors would suggest you invest for at least 5 years. This allows enough time to ride out any bumps in the market that might see you make a loss on your money. Always remember the 5 golden rules of investing. The greater return you want, the more risk you'll usually have to accept. Don't put all your eggs in one basket. Try to diversify as much as you can to lower your risk exposure. Invest in different companies, industries, and regions. If you're saving over the short term, it's wise not to take too much of a risk. It's recommended you invest for at least 5 years. If you can't, it's often best to steer clear of investing and leave your money in a savings account. Review your portfolio. A share might be a dud, or you might not be willing to take as many risks as you did before. If you don't review your portfolio regularly, you could end up with a share account which loses money. Don't panic. Investments can go down as well as up. Don't be tempted to sell or buy shares just because everyone else is. Thanks for watching. And don't forget to like and subscribe for more videos like this one.